Top of the morning to you, Peter.
Top of the morning to you as well, Daniela.
And I shouldn't be smiling, at least when we're talking gold, Peter, the metal hitting a 4-month low on day one of the FOMC. And that's the topic we're going to kick off with today, what we can expect from the Fed meeting. Rates have been so low for so long now, Peter, it almost seems inevitable that the Fed will need to raise rates. Do you think that the Fed will be backed into a corner here?
Well, I think they're in the corner already, and I just hope that they don't raise rates. Given the global scenario, the deflationary scenario, disinflationary scenario, at least in Europe, Japan's still not firing. China growth is slowing. And, the U.S. economic numbers that have been coming out recently, some have been okay, but, they're not stellar. And, home sales were extremely negative for February, much below analysts' expectations. And yeah, it could have been the weather, but it just doesn't feel like the U.S. economy is revving up, which would signal the potential start of inflationary wage pressures. It's just not evident. So the Fed might raise rates only because they feel they need to satisfy what the market thinks. On the basis that the Fed's behind in the curve. I just don't see it. I just don't see a reason for the Fed to raise rates yet. They may change some of the language tomorrow in the afternoon announcement, which I think will have an impact on the markets. But I'm still in the camp that the Fed keeps its powder dry and waits a little longer before it starts getting in the way of this market by raising rates. It would be huge impact again for the dollar going higher, would hurt the multinationals. There's just a lot of negatives to raising rates too soon.
So, Peter, if it were to happen, September looking like the best bet now?
Yeah, and even if it does happen, maybe they go a quarter point when they go. And I think that might actually be bullish for the market because it's finally out of the way. It's like, get it over with already. And if you're going to raise the rates, go a quarter point, take your pain, and let's move on. And
that's really well said, Peter, because it really has been hovering over gold.
Well, it's hovering over everything. It's basically creating a much stronger dollar. It's impacting the oil price. It's impacting a lot of things. And sometimes the rumor creates a lot of the panic, and then when the fact comes out, everything reverses. And I just don't see the Fed normalizing rates to 1 or 2% anytime soon. Maybe they go a quarter, and maybe they go again a quarter next year, but that's about it. So I don't know why the market is reacting as badly as it is, but it is what it is.
Taking a closer look at gold now, Peter, Barclays put out an interesting report where the analysts looked at historical rate hikes, and they noted that gold prices tend to fall 2% in the 3 months leading up to the rate hikes, except for the rate hike cycles of 2004 and 2006. So far this month, gold has fallen 5.7%. Is gold oversold now, Peter, or do you think there's more room for a decline?
Well, you have to take it in the context of where we are today relative to some of the historical data that this gentleman probably looked at. And, we're in a very, very unusual situation. I don't remember in my 40-odd years in this business where everybody on the planet was basically printing money and trying to debase their currency at the same time. This is unprecedented. And, the Fed raising rates, they may go, but, I don't see it. So I think the context of his comments don't line up with the realities of today's market. As far as where I see the gold market, again, we may see a pop up, but the fundamentals, as long as the dollar remains strong, which seems to be the case, the Europeans want that euro down, and, we've been calling for parity for a while, and I think parity is the minimum target. It wouldn't surprise me to see the euro trading in the low 90s over the next 6 months. As the cycle of sort of stronger U.S. growth is ahead of the curve of the European recovery, and that's been a story for 2 years. We've been saying that the U.S. is well ahead of the curve against the Europeans, and it's going to hurt the euro. In a context of a stronger dollar, and in my opinion, oil still seeing at least a 3 handle coming up very shortly. It's difficult for me to be bullish the metals. Unless there is a financial shock which still may come with possibly a Greek exit from the euro or some issues with Spanish and Italian banks. But unless there's a financial shock, it's difficult for me to understand why gold would not see, a print with a 1-0 in front of the number as opposed to an 11.
Well, good thoughts from you, Peter. We'll see what comes out of the meeting tomorrow.
Yeah, I think tomorrow is going to be extremely volatile. I think the markets are going to jockey around to square positions ahead of the 2 o'clock announcement. And then depending on the wording, there could be a lot of fireworks coming in right after around 2 o'clock.
Well, it really is all about that word, patience.
That's it.
Well, thanks so much, Peter, and happy St. Patrick's Day.
Yep, same to you, Daniela.
And thanks for watching this edition of For Pete's Sake with Peter Hug. We'll see you tomorrow.